Welcome to the deep dive.
Great to be here.
Today we're taking a close look at something that, well, many of you thinking about retirement options might be wondering about.
Mm-hmm.
Specifically, the tax implications when you roll funds over into a Gold IRA.
Yeah, it's a hot topic. And we're using a really helpful article by Doug Young called What are the Tax Implications of a Gold IRA Rollover as our guide today.
Right, and our goal, our mission for this deep dive, is really to cut through some of that complexity.
Exactly. We want to pull out the key facts, the actionable stuff from Doug's piece, so you can understand the potential tax landscape.
And critically, how to navigate it, without hitting any nasty tax surprises.
Precisely. Avoiding those pitfalls is key.
It definitely feels like Gold IRAs are getting more buzz lately. Doug Young's article touches on why, doesn't it?
It does. He really frames it around, well, specific financial goals people have. Things like hedging against inflation, maybe economic uncertainty.
Diversification too, right?
Yeah.
Getting beyond just stocks and bonds.
Absolutely. Diversifying the retirement portfolio, maybe looking for potential long-term growth, or just preserving wealth with physical assets.
Makes sense. But those goals, they run right into the tax rules, don't they?
That's the crux of it. So let's start at the beginning. What exactly is a Gold IRA rollover, based on Doug's explanation?
Okay, yeah, let's define that.
So at its core, he describes it simply as a transfer. You're taking funds already in a retirement account, maybe a traditional IRA or Roth, even an old 401k,
Right.
and you're moving them into a new IRA, one that's specifically set up to hold physical precious metals. Gold, usually, but could be silver, platinum.
Got it. And the purpose, again, is that diversification, that protection against market swings.
That's typically the driver, yeah, adding a different kind of asset.
And Doug points out there are basically two main ways to actually do this transfer.
He does, and this distinction is, well, it's super important for tax reasons. First up is the direct rollover. This is where the money moves straight from your current account custodian to the new Gold IRA custodian. They handle it between them.
So you don't touch the money yourself.
Exactly. And Doug's article is clear. This way is much more straightforward. It really minimizes the risk of tax penalties.
Straightforward, low risk. Sounds appealing. What's the other option he mentions?
That's the indirect rollover. And this is where things get trickier and definitely riskier.
House.
Well, in an indirect rollover, the funds from your old account are sent to you personally.
Yeah.
You actually receive the money.
Oh, okay.
Then the responsibility falls entirely on you to deposit that exact amount into the new Gold IRA. And here's the kicker. You have just 60 days to do it.
60 days. That sounds tight.
It is
Very.
very strict, non-negotiable.
Yeah.
Doug's piece really emphasizes the risks here, huge potential tax penalties, if you miss that 60-day window for any reason.
Wow. Okay. So the mechanics are one thing, but the actual tax hit depends a lot on where the money started. Right. Traditional versus Roth IRA.
This is a central point in Doug Young's analysis. The tax treatment, both for the rollover itself and then later when you take money out of the Gold IRA, it all hinges on whether those funds began life in a traditional IRA or a Roth IRA.
Because they have totally different tax setups.
Completely different. He reminds us, the basics. With the traditional IRA, you usually got a tax deduction for your contributions back when you made them.
Right. The money went in pre-tax.
So it's grown tax deferred all this time. But the flip side is you pay ordinary income tax on all your withdrawals in retirement.
And those RMDs apply too, the required minimum distributions?
Yes, those apply once you hit that certain age, which has been changing recently, but we'll get to that.
Okay, so tax benefit was upfront for traditional. What about Roth?
Roth IRA, it's the mirror image.
Yep.
You put in money you'd already paid income tax on. After-tax contributions.
So no tax break going in.
Correct. But the big advantage is, if you follow the rules, your qualified withdrawals in retirement are completely tax-free. The growth, the withdrawals, all tax-free.
And no RMDs for the original owner, typically.
Right, no RMDs on Roths for the person who opened it.
Okay, got it. So how does rolling over from each type impact the Gold IRA specifically, tax-wise?
Well, if you're rolling from a traditional IRA to a Gold IRA, Doug explains you're basically just moving those tax-deferred funds into another tax-deferred vehicle.
So no tax due on the rollover itself?
Generally, no. Not if done correctly, especially with a direct rollover. The tax obligation is still pushed down the road until you take distributions from the Gold IRA in retirement.
And Doug notes that could be good if you expect to be in a lower tax bracket later on.
Exactly. That's a potential strategic element.
What about rolling over from a Roth IRA?
Since that money was already taxed, it's different. Doug clarifies that as long as the rollover is handled properly, the tax character follows the money. So Qualified withdrawals from the Gold IRA that came from Roth funds should still be tax-free.
You're just swapping investment types within that Roth wrapper, essentially.
Precisely. You're keeping that tax-free status, just holding gold instead of, say, stocks or bonds.
Okay, this really drives home the point about following the rules to the letter. Doug stresses that pretty heavily, doesn't he?
Oh, absolutely. He couldn't be more direct. If you fail to follow the IRS regulations, whether it's the procedures, the timing, anything, you will likely face significant, often quite costly tax penalties.
Yeah, it could turn what you thought was a smart diversification move into a sudden, unexpected tax bill.
Exactly. A potentially avoidable tax bill.
Nobody wants that. So Doug Young's article gives some pretty clear steps on how to manage this tax side and avoid those mistakes. What's his #1 piece of advice?
It's advice we hear often for complex financial moves, and he really emphasizes it. Talk to a professional. Consult a qualified financial advisor or a tax expert.
This isn't a weekend DIY project.
Definitely not for most people. He stresses that a pro can give you tailored advice for your specific situation, help you understand all the potential consequences, and crucially guide you through the actual process to make sure it's done right.
And building on that, he circles back to the rollover procedures again, the direct versus indirect methods.
Yes, because choosing the right procedure is probably the single biggest way to avoid immediate tax problems. He strongly recommends the direct rollover
Why again?
because it takes you out of the equation. The money goes straight from custodian A to custodian B. You never have access to it, which eliminates the risk of accidentally triggering that 60-day rule associated with the indirect method.
Right, that ticking clock on the indirect one.
Exactly. If you have to do an indirect rollover, maybe your old custodian doesn't support direct transfers, it happens. That 60-day countdown starts the second you receive the funds. Miss it by 1 day.
And the whole amount is treated as if you just took it out.
The whole amount becomes a taxable distribution, subject to ordinary income tax and potentially that 10% early withdrawal penalty if you're under 59.5. It's a huge potential hit.
Okay, so direct is strongly preferred. That 60-day window is like walking a tightrope. What about paperwork? Doug says keeping good records is vital.
Absolutely critical. Think about it. The IRS might ask about this years later. Good documentation is your proof that you did everything correctly.
What kind of records does he suggest keeping?
He lists several things. Really detailed notes of the amount rolled over, the date it happened. Keep all your communications with both the old and the new custodians, copies of the actual rollover forms, and any confirmation statements they send you.
Okay.
And definitely records of any fees you paid as much of the process.
He even calls out specific IRS forms involved.
Yeah, he mentions Form 1099-R. That's the one your old custodian sends out. It reports the distribution from the original account, but should indicate it was a rollover, not a regular withdrawal.
Right.
Then there's Form 5498. Your new Gold IRA custodian sends this one, confirming they received the rollover contribution into the new account.
So those forms create the official paper trail for the IRS.
That's right. They validate the whole transaction from the IRS's perspective.
Now, beyond just the mechanics and avoiding errors, does Doug offer any strategic tips regarding taxes?
He does touch on a few things. One interesting point is about timing your rollover.
How so?
Well, his article suggests that if you have some flexibility, doing the rollover in a year when your overall income is lower might reduce any potential tax impact. He gives the example of maybe waiting until you retire when your income often drops.
Because if any part of it somehow became taxable, it would be taxed at that lower rate.
Potentially, yes. Or if you were doing a Roth conversion, which is taxable, timing matters even more. But even for a standard rollover, he notes, quote, timing is everything. Rolling over during a low-income year can save you a significant amount in taxes. Something to consider.
Makes sense. And he definitely champions using that tax-free nature of the direct rollover.
Oh, yeah. He stresses that point multiple times. A direct rollover, done right, is tax-free at the time of the transfer. You're just moving assets between accounts that already have tax advantages.
He uses a quote for that too, right?
He does. A direct rollover is the most straightforward and tax-efficient way to convert your existing IRA to a Gold IRA. The tax issue simply doesn't arise until you actually start taking money out of that Gold IRA, usually in retirement.
Okay. Now, he briefly mentions tax harvesting. That feels a bit different.
It is quite different. Tax loss harvesting is usually about selling investments, like stocks, that have gone down in value to offset capital gains from investments that have gone up.
Right. A strategy to reduce your current tax bill.
Exactly. Doug notes it's much more common with stocks
Mm.
and says it could theoretically be applied in some precious metal situations.
But with a warning.
A big one.
Yeah.
He immediately follows up by saying this is complex stuff and you absolutely should consult a tax or financial advisor before even considering it for a gold IRA. It's not a typical or simple strategy for this kind of asset.
Yeah, that just reinforces the need for that professional advice again. Okay, let's quickly recap the common mistakes Doug flags, the things to definitely avoid.
Sure. He lists several key ones. Top of the list, because the consequences are so immediate and harsh, is missing the 60-day deadline for an indirect rollover.
Turns the whole thing taxable.
Instantly.
Yeah.
Then there's the mistake of not consulting a financial advisor. Trying to navigate these rules alone can lead to very costly errors.
Right.
Improper documentation is another big one he highlights.
Yeah.
The IRS questions the rollover later and you don't have the proof, you could face problems, maybe penalties.
And there was one more subtle one, the limit on rollovers.
Yes, exceeding the one rollover per year limit.
And just to be super clear on that limit, Doug specifies it's one indirect rollover per IRA account per year, correct? Not just one total across everything.
That's a really critical distinction he makes, yes. The IRS rule is generally one indirect rollover allowed from a specific IRA within any 12-month period. So if you have 3 different IRAs, you could potentially do one indirect rollover from each in a year, but not 2 from the same one.
And direct rollovers, the custodian-to-custodian ones, they don't count towards this limit at all.
Correct. Direct transfers aren't subject to that once per year limitation. Another reason they're often preferred.
Good clarification. Doug also brings the wider regulatory picture into focus, mentioning how recent tax law changes affect retirement accounts generally.
Yeah, he points out a couple big ones you should be aware of. The Secure Act of 2019 made some significant changes.
Like the RMD age.
Exactly. He notes it pushed the starting age for required minimum distributions from 70.5 up to 72. And he adds, importantly, that it actually went up again to age 73 starting in 2024.
So that gives your money, whether it's in a traditional IRA or potentially a gold IRA funded from one, more time to grow tax deferred before you have to start taking it out.
Right. More runway for potential tax-deferred growth.
What other legislation did he mention?
He also referenced the Tax Cuts and Jobs Act, TCJA, from 2017. Now, that didn't directly change IRA rollover rules, but Doug points out that because it changed things like the overall tax brackets and deductions, it can significantly impact your total tax picture. So understanding how TCJA affects you personally is part of the context when you're evaluating the tax implications of any retirement move, including a gold IRA rollover.
So keeping up with these legislative shifts isn't just for accountants. It's actually vital for your own retirement planning.
Absolutely. The rules aren't set in stone. Changes can create new planning opportunities or sometimes new complications you need to factor in when you make decisions about something like a gold IRA rollover.
Lastly, Doug brings it all back to the bigger picture, how a gold IRA fits into your overall financial plan. What's the main idea there?
He really emphasizes that a gold IRA shouldn't be viewed in isolation. It's one piece of your retirement puzzle.
Part of a larger strategy.
Exactly. It's about balancing your portfolio, diversifying, managing risk. He frames gold's role specifically as that hedge against things like inflation or big market downturns. It potentially adds stability that might be missing from just stocks and bonds.
But not necessarily putting all your eggs in the gold basket.
Definitely not. He stresses working with a financial advisor to figure out the right allocation to gold for your specific goals and risk tolerance. It's not about going all in. It's about strategic placement.
And he briefly mentions other asset types to keep in mind for that well-rounded portfolio.
Yeah, just a quick reminder about the importance of broader diversification. Things like stocks, bonds, maybe real estate, mutual funds, or ETFs for diversification within asset classes, and making sure you have some cash or equivalents for liquidity.
So the gold IRA is one tool in the toolbox, not the whole toolbox.
That's a good way to put it. One potentially valuable tool in a larger strategy.
Okay, this has been incredibly useful, pulling these insights from Doug Young's article. If we boil it down, the key takeaways he really hits home are, first, understand those two rollover types, direct versus indirect, and seriously appreciate the risks tied to the indirect one.
Second, know exactly how the taxes work, depending on whether the money came from a traditional or a Roth IRA. That's fundamental.
Third, the absolute necessity, really, of consulting a financial advisor. Don't go it alone.
Right. Fourth, document everything meticulously. Keep that paper trail.
And fifth, be hyper aware of those key IRS rules. that strict 60-day deadline for indirect rollovers, and the one rollover per year limit that applies per IRA.
And throughout the article, Doug consistently circles back to the idea that if you do it right, especially with a direct rollover, it's generally the most straightforward and tax-efficient method the IRS provides.
Absolutely. Diligence, caution, and getting expert help seem to be the recurring themes. So here's a final thought for you, the listener, to mull over based on this deep dive into Doug Young's insights.
Hmm?
Considering the points he raised about timing, how your income level in a given year could matter, and also factoring in that major tax laws do change over time, like we saw with the Secure Act pushing back RMDs or the TCJA shifting tax bracket.
Right, the landscape evolves.
Exactly. So how might your own best guess about your future income, or even just the possibility of future changes to tax laws, influence whether a Gold IRA rollover makes sense for you? Or maybe more pointedly, influence when might be the most tax-smart time to consider it within your unique retirement strategy?
That's a great question to ponder. It really ties together the personal financial picture, the tax rules, and the element of time.
Give that some thought, and perhaps consider if reaching out for that professional consultation Doug recommends is really your most crucial next step.